Hello, welcome to Rational Investing. My name is Cameron Stewart. Thank you very much for watching the channel. I greatly appreciate all the comments, subscribers. The comment section down below is off the chain with value stocks. Thank you guys very much. Really appreciate it. This week up, we're going to take a look at Shopify. Now, Shopify is the massive e-commerce behemoth that has been growing like a missile for the last decade or so. Recent stock market has absolutely crushed this stock. What we're going to do is we're going to pick apart the pieces, figure out how much cash money does Shopify actually produce, and then if we carry that out forward with a conservative forecast, how much do we think we can make on this stock if we bought it today and held it for 10 years? Ready? Let's get to work. Let's take a look at the 5 key attributes that we're going to review for this stock and all stocks. Number 1, top line revenue growth. It's got to be growing. Number 2, EBITDA growth. We want to see strong EBITDA. Number 3, strong free cash flow. Number 4, low debt. Number 5, well priced. Now, those are 5 key attributes that we use as a starting point for evaluating any stock. What is a well-priced stock? A well-priced stock is a stock that I can produce a simple, conservative growth forecast for the stock out a decade, and that growth forecast is projected to beat the stock market. That's ultimately our goal. We want to outperform the stock market in a safe manner. That's what we're trying to do. And interesting, this absolute carnage that's going on in the stock market right now is providing an interesting opportunity for stock pickers like you and I to go through, read the 10Ks, review the numbers, put together an economic model, and see how much we can make by buying these fallen angels. All right, let's take a look at Shopify. Okay, let's review the Q1 2022 earnings release for Shopify. What we're going to do is pull out a couple pieces of information here. Then we'll click to our long-term forecasting model. But I want to show you a couple things that I found interesting on this deck. First couple pages is just financial data point, which is nice. Revenue grew 20% year over year for the quarter to $1.2 billion. And then the GMV, the gross merchandise value, the value of all the goods moving through their enterprise, grew by 16% year over year to $43 billion. We're going to annualize that. That's about $170 billion in gross merchandise value, all the products being sold through their platform, of which they take a small rip. That's how they generate most of their revenue. Here is just a percentage of e-commerce relative to full retail sales. So take all retail sales in the United States, and then of that, what percent of it is e-commerce? That's what this line is showing. E-commerce is continuing to grow. It had a nice spike for COVID, kind of following the trend line again. Here's their gross merchandise value chart. You can see it dipped this quarter, which is Q1, which is seasonally accurate. All Q1 for them is always a down quarter. So the idea is that even though this is declining, even though we could be in a possible recession moment, it's hard to know if this is going to continue going or it's going to revert back up like it has historically. We're going to assume it's going to go up, but we're going to see what the difference is in price if you assume a higher growth rate or a lower growth rate. The rest of it is some pieces on the queue, and the rest of it is all high gloss stuff. A lot of flashy pictures. They really don't go through free cash flow like we would like. It's a lot of pictures of people who are successful entrepreneurs on their website, but it is not the black and white hard cash money presentation that we'd like to see. So I think that's one thing that stood out to me. But let's go through the revenue earnings and figure out how much money these guys make. Okay, behind me is Shopify's long-term revenue. So in 2013, they had $50 million of revenue. They most recently printed $4.6 billion of revenue. That is monster growth over this time frame. You can see the annualized revenue growth here, 100%, 90s, kind of 70s, 60s, 50s, but for this bump. So the revenue is coming down in growth rate. Obviously, as they get bigger, it's harder to grow as a percentage. So we're going to continue that pattern as we go down. The question is, how low does that go? We're going to have to figure that one out and take a guess. Also, EBITDA margin is improving, which is nice to see. We're all going to assume that that's going to grow as a percentage of revenue. EBITDA for them, negative, turned positive recently. Last couple of years, it's been going the right direction is what we want to see, and it does show that the business is scaling. The profit is growing with size, that it is able to scale. So both these are going to check our box for growth. The both of them are doing well. They're both growing. That's all one of the hallmarks that we want to see. Debt. When we look at enterprise value, we want to see how much debt the business has. They have very, very little debt, which is nice. Cash on hand, they have a lot of cash on hand. In fact, they have $5.3 billion of cash on hand on the balance sheet, not including the cash in the checking account. Now, this is just short-term investment cash. That's a lot of jack that they have, and it's nice to see it clears all the debt that they have on the balance sheet, which is a nice check box that we like to see. Market cap, shares outstanding times price, $1.6 billion what they IPO'd at. $175 billion is a huge market cap. Enterprise value is basically market cap because these two are so small, so it follows the same pattern. Debt to EBITDA is basically zero because they had no debt historically. They have a little bit of debt, but when I subtract it from the cash, it's zero, so that's fine. The enterprise value to EBITDA is a big concern here. As I expressed in the last video I did, it was 750 times EBITDA, a massively number. Now, what is this? Enterprise value, that's this column. EBITDA is over there. Enterprise value is the entire value of the business. Dividing that by the earnings it makes on an annual basis is somewhat of a payback period. Basically, how many times does the business have to operate in order to buy itself back? We as equity investors want to buy a business that's generating the highest earnings possible, right? Because that's where we're putting our money to work. So this thing is massively large. That means many, many years. If it doesn't grow, it would have to maintain the same level of earnings to pay us back. And that's 700, right now it's 471 years of operations for this business to earn back its enterprise value. That's very, very, very high. Historically, let's see, the S&P 500 is maybe 16 times. This is 470. So obviously people are expecting it to grow. The question is how fast it grows. Would it make its money back? And we're gonna look at that when we do the forecast. Let's take a look at cash flow and see how much money they keep. Okay, cash flow from operations. My favorite statement, your favorite statement, the cash flow statement. Cash flow statement here is kind of the same story. So it's growing $1 million to $174 million. This growth rate follows the growth rate of EBITDA. So I think the accounting team is expensing cash costs appropriately on the P&L. Good job, team. Thank you, guys and girls. But this number is very, very low. This number is also after I've adjusted the cash flow from operations that they show you on the cash flow statement in their 10Ks. I've adjusted it for the non-cash stock-based comp they pay their employees. And in fact, in this year, last year, they paid their employees over $300 million in stock-based comp. Prior to that, this year it was like $200 and something million. Now, that's a cost. It shows up down here, but it's very, very high. $300 million for a company that makes 8% earnings is very, very massive. And the problem is if you cut that off, the employees are going to want their compensation. They could go elsewhere. So it's a real cost. It needs to be included. A lot of companies exclude it. We don't. It definitely needs to be impacted. And I'm cash expensing it as though the company paid them in cash because I want to reflect what consideration they're giving their employees in the cash. CAPEX, very, very low because it's a tech company. Most everything is expensed on the P&L. So this flows through to the enterprise level free cash flow to equity. That's what you and I are buying. This is the ultimate cash that can go to the owners, which is the common stock owners. And the number of shares outstanding. Number of shares outstanding have been growing substantially, which is weird. You think with a company that makes that much cash, they would not have to also dilute themselves so bad, dilute the shareholders so badly, but they do. 37 million when they IPO'd, probably 62 million shares outstanding when they IPO'd. That's up, 2 times that number since they IPO'd, which is weird. If they're growing so fast, profitable, generating cash, why would they then have to dilute the shareholder? So I don't like that. I don't like that at all. But when I take the free cash flow to equity, divide by the shares, I get free cash flow per share, basically $1. When I look on a per share basis, the stock price IPO'd at $25, and it's gone up to $1,300, $1,400, kind of at its peak. And in terms of a cash flow yield, that is 0.1%. That's right, 0.1%. You want to talk about outrageously expensive. That corresponds to the 400 times EBITDA, right? So we look for stocks on this channel that are in the kind of high single-digit yields, talking 6, 8, 10% yield. This is 0.1%. So in terms of a cash flowing business, it's weak. I will say that. They give away a lot of money into the employees' stock-based comp, and the stock price itself, at least at this time in December of last year, was so high that the cash flow yield just doesn't make any sense. Okay, now the question is, what do we do from here? All right, well, I will take a moment to pause and tell you that I do teach a course on how to review 10Ks. Check out my website, cashflowinvestingpro.com, where I teach you how to be a financial analyst, how to do this for yourself. Okay, let's keep going. We're going to build two different economic models here to figure out what we want to do. The first one, I'll do the rosy case, is let's just take their numbers. Okay, so now we're going to forecast the business, and we're going to build two different forecasts to show you kind of a rosy, optimistic case for Shopify, and then maybe a more realistic, lower case to give you some gauge, because I don't know what's going to happen. I don't know if we're going to go in a recession. We could already actually be in a recession. The oil shock and inflation is very hard on the consumer. We're a consumer-driven economy. Most people were living paycheck to paycheck prior to this. And from what I can read on a Goldman Sachs Q4 analysis, that most of economic activity in Q4 of last year was driven by stimulus checks and PPP funding. So I don't think now that all that stuff is washed through, plus inflation, plus the oil, that the consumer is doing very well. And because we're a consumer-based economy, I think that's coming down. Personal opinion, but my point here is nobody knows what the future holds. So having a gross forecast is basically just throwing a dart in a dartboard. So what we're going to do is we're going to produce two different cases. We're going to kind of judge them based on the risk-reward basis of each of them. So the first thing I want to do is I want to take a look at what have they been doing in their growth in the past. What is Shopify been growing at? Remember, I said it was growing revenue here, a kind of 50-60% range. It was coming down. Well, I'm going to take a look and say they're going to grow 40% year over year. And when I kind of annualize the Q1 number, it's actually a little less than this, but I'm going to give them some benefit of the doubt and say this is a rosy case. They're kind of pull it off. And that means they're going to get to about $6.5 billion of revenue. I'll give them a little bit extra EBITDA margin as that margin grows over time to about a 20% margin. And that means they should be around $600 million of EBITDA in 2021. And as always, I bring down the growth rate over time. As they scale, they should mature as a business, and the revenue goes from $6.5 billion to $53 billion out long term at a 20% margin, someplace around a $10 billion EBITDA target for this business is kind of what I think they could generate. If I then put it on a free cash flow basis, because they have stock-based comp, because it's so massive, I am hitting cash flow again post stock-based comp. So I think they're going to generate, after $600 million of EBITDA, they'll actually make cash of $300. That will grow to $7.5 billion over time. CAPEX on a consolidated basis, I'm targeting about a $6.5 billion long-term free cash flow to the enterprise. Divide that by shares, I get my per share cash flow. So that's one way of thinking about the business. It's a rosy way. It basically says, hey, they have to pull off two massive objectives. One, they've got to grow strong double digits out for a decade when we could be on the cusp of a recession. Who knows? Okay, fine, that's one. Two, they have to grow operating margin. They have to grow operating margins from basically double, from 9% to 20%. Those are two very big asks over the next decade. They may or may not do it. The question is, how much do you want to pay for this forecast? What happens if you're wrong? Let's take a look at another way of looking at forecasting their business. All right, so we're going to take a look at a different way, and we're going to forecast it kind of from the macro level down. And what you're seeing behind me is the revenue that Shopify generates. Most of their revenue is generated from the gross merchandise value rolling through their enterprise and them taking a percentage of that business. Well, so what is that percentage? Well, here's the revenue they've reported in millions. There's the $4.6 billion. This is the gross merchandise value that they roll through, and that has been growing nicely too, up to $1.75 billion of money. When they divide these two, I get a percentage. And over time, you can see it's averaged 2.5%. So basically what they're doing, what this is saying is, for every dollar that goes through their Shopify store, they make 2.5 cents, which is a great business model. You and I both know I love tolling relationships. I love recurring revenue models. Being on Shopify's ecosystem, if you're a successful business, it's very hard to move off that structure. You could disrupt the business, which cost you millions of dollars, when your website isn't functioning, you're losing customers every single day. So it could be very risky to move off that. And if you're successful, why would you stop? You just continue to grow and expand along with Shopify. I like that. Also, with inflation, if this number is growing because retail is passing along costs with higher consumer products, then as a percentage of business, I, as a Shopify owner, am getting a higher revenue number because my customers, the merchants, are raising their prices. So it's a nice little inflation hedge. I kind of like that. So this 2.5% gives me a way to represent the economic activity into revenue. And what I'll do is I'll come up here and I'll say, okay, what is total U.S. Retail business? Well, last year it was $6.6 trillion. These are still in millions. So this is $6.6 trillion. How big was e-commerce? Well, you saw in that chart earlier in Q1 from Shopify that it's about 14%. This is retail as a percentage of, this is e-commerce as a percentage of total U.S. retail, 14%. That means e-commerce last year was $924 billion. And if I said Shopify is roughly 19% of all e-commerce, that means their gross merchandise value is $175 billion, which is what we saw in the previous slide. Well, if I know that they make on average 2.5%, here's their revenue, at a 9% margin, I get an EBITDA. It's pretty easy, just logic your way through it. And so what you do is I back all the way up to U.S. retail. We start here again. So, okay, what do we think U.S. retail is going to do over the long term? Well, it's such a massive number, it really doesn't grow that fast. I can give it a 5% growth in the near term because of inflation. This could be lower. If we have a recession, it actually decreases. Who knows? But I'm still assuming a growth forecast. I want to make sure that's out there, and we will judge the return on this investment with the risk later on. But the point here is 5 to 4 to 3% growth of U.S. retail. I think e-commerce is going to continue to march forward, taking a larger and larger percentage of total U.S. retail to 30% out 10 years from now. Shopify, as they continue to cement themselves inside the U.S. economy, as their customers grow and become sustainable, they're not going to move off the platform. So I think they'll take a growing chunk of that business from 19 to 23%. That means the gross merchandise value is going to approach $600 billion. Take the same 2.5% on that, I get a revenue of $15 billion. I'd use my EBITDA margin to 20%, I get a long-term EBITDA target of $3 billion. That, at a 20 multiple FY, puts me in an enterprise value of about $60 billion. They're currently, after the market fell, $40 billion. So there could be a 40% discount to long-term value. What does that mean in terms of cash flow and IRRs? We'll figure that out. But there's a potential here we start getting into the discounting zone of where they may fall on a more conservative forecast. Okay, that's the two forecasts. We've got one, which is the rosy number, taking their historical growth and kind of bringing it down over time in a margin. And we have two where we start macro level and we say, hey, U.S. economy, e-commerce, Shopify, how big could they get? And these two are noticeably different. When we do the economic model from Shopify and you get $10 billion of EBITDA, that $10 billion still needs to live inside the U.S. retail world, which means that it's projected that Shopify would be 3 times the size it is here, which I think could be a stretch. But let's put it into our IRR and figure out what it's worth. Okay, now before we forecast stock prices for Shopify, I want to remind you I teach a course at Cash Flow Investing Pro. You can also find one-pagers there if you join the Cash Flow Club. We are printing lots and lots of one-pagers for companies that I can't possibly review all of them on a weekly channel. Definitely check it out. It's well worth the money. Here we go. This is the EBITDA forecast for the more aggressive case where I take Shopify's revenue and I grow it at 40, 30, 40% out in the future. I get a $10 billion number. I put a 20 times market multiple on that $10 billion and I get a $216 billion enterprise value. I said zero debt, zero cash for simplicity. There's 127 million shares outstanding. Again, they're paying cash as stock-based comp, so I'm expensing that. I'm not diluting the shares. So that puts a $1,700 price target out for Shopify out 10 years. Now let's look at free cash flow under the same economic scenario where we're taking Shopify's growth numbers and we're growing them. I get $1.97 of cash flow, and that grows to $50 a share out in 10 years, which is a big, big move. I apply a 3% cash flow yield on that, again, lower than the 0.1% now, and I get $1,700 in as a price target. Okay, as an option 2 here, I just want to show you quickly the lower forecast. So $410 makes $3 billion of long-term EBITDA at a 20 handle of market multiple. Same setup, same shares. That's $500 per share, which is markedly less than the $1,700 we just saw. We do the same thing for free cash flow. I get $1.26, much less growth, $8.63 of long-term free cash. At a 3% yield, give me $287 per share on a free cash flow basis, not the $1,700 that we saw earlier. Now let's put these in our IRR and figure out what the return is. Okay, here we are. I've got 2 different ways of estimating price. I've got a free cash flow method under the growth scenario of $1,688, and I've got a EBITDA market multiple of $1,700 and change. These are very close to one another. I'm going to average the 2 and I'll get $1,700 per share. I can buy all the stock I want right now at $368 per share. Let's put this in an IRR forecast and figure out what it's worth. Okay, here we are. Under the growth scenario, I've got my cash flow. I'm buying the shares. I'm selling at $1,700 a share. This stream of cash flow will give me a 21% IRR every single year from now to a decade if I buy the stock and this forecast happens. Okay, so here we've got a distribution. $368 is the current price. Under this economic scenario, I get 21% as an IRR, which is very strong every single year over a decade. The price goes up, less interested. Price comes down, more interested. What does it do when we change into the lower forecast? Okay, now we've put the lower forecast in here. I've got 2 different price targets, $287 and $500. Split the difference, call it $394 a share. I can buy all I want for $368. If I put this in an IRR forecast, I get a lower free cash flow. I'm in and out for roughly the same price. I'm making a 2% IRR on this lower forecast. Again, this forecast is built up from the macro level down rather than looking at micro up. So I'm saying all retail, e-commerce, Shopify is a percentage of e-commerce, and then Shopify's margin on the gross market value, gross merchandise value, to give me a long-term EBITDA target. This is 2%. So I think, let me put this into a matrix and show you. On a matrix, it's 2% currently. It's going to come down a lot in price to become much, much more attractive. So let's review where we are. Let's look at top line revenue growth is growing, yes. EBITDA, yes, it's growing. Free cash flow is there, it's positive. Low debt, yes. Well priced, possibly. I'll give it a question mark because it depends on the scenario that you want. If you believe the long-term forecast and you're willing to roll the dice that the economy is going to recover and they're going to continue to grow at that rate, then it's a buy. If you're saying, hey, we could be in a customer recession, there could be a much slower economy going forward, or you don't believe in that forecast, you want to look at macro down, there's not enough of a cushion of a moat here, of a margin of safety, as Buffett likes to say, that I think when I use a lower forecast to produce a 2% return and have no dividend is not worth it for us. So for me, I'm going to give it a meh. Why? Because I like the business, but I think the risk of buying the stock right now, given the downward trajectory, is too high. And with a forecast that I think is very reasonable, using the U.S. retail to gross merchandise value and a spread, I think this is a very reasonable forecast for them. And in doing so, they still vastly underperform the market. So I'm a pass for me personally and this channel. Now, if you like this, I want to remind you about my course at Cash Flow Investing Pro. Now, this course is going to teach you how to think analytically about stocks. It's not a trading course. It is how to read a 10K. I will give you this Excel sheet that I use. I will show you how to pull out revenue, EBITDA, free cash flow. I will show you how to adjust for share dilution and share buybacks to get the proper share count. And I'll teach you this that you can carry on for the rest of your life. Now, if you're a young investor, 20, 30-year-old, you're going to be investing for 60, 80 years, hopefully. And this one course, this knowledge, you can carry through for the rest of your life. And I really encourage you, check out the website, check out the course. It's vastly, vastly interesting. I will also say that the Cash Flow Club is gaining steam. We're getting more and more members, and I'm hiring analysts. If you're interested, you can ping me at the link below to become an analyst of the Cash Flow Club. But what we do is we publish reports on lots of stocks every day. What you get is you get 10 years of financial information, historical numbers, showing free cash flow per share. We build a forecast just like we do here so you can see it. I give a chart, we talk about the company, and you get the 5 key attributes right off the side to give you a handy chart. What I would suggest doing is you print out any of these for companies that you like. You keep them off the side and you look at the stock price once a quarter, and you see if the stock price falls into a range that makes sense, then it's a consideration for something to purchase. Definitely check that out. Also, in the link below, you can download a free one-pager. If you go to my website, cashflowinvestingpro.com, you follow the link at the upper left corner for the Cash Flow Club. You click preview. In there, I let you download a very free report so you can take a look at it for yourself. Let me know what other stocks you want to see. This has been Shopify. Very, very interesting stock. I think there's starting to get into value countries. If the stock would decline another $100, it becomes a very, very attractive buy, in my opinion. But right now, we're a hold off. So up is going to pop a couple more value videos. Take a look at some of the other stocks I've reviewed. Definitely check out the Google versus Domino's IPO video. Very, very proper lesson there. And let me know what else you want to throw. Throw a comment down below. Hit the like button. And don't forget to subscribe. Thank you very much, and have a good day. Bye-bye.